Good morning and welcome to today's webinar from East Capital Group. My name is Marcus Rågmark. I'm a member of the sales team at East Capital. I'm glad to have with me, beside me, Anders Borg, our senior advisor. And we also have Jacob Grapengiesser dialing in live from China. Jacob is the CIO of East Capital. As you know, the past week, of course, has brought a lot of volatility and instability to global markets following the breakout of the war in Iran and rising geopolitical tensions in the Middle East, with particularly sharp effects in certain markets such as South Korea and Taiwan. Of course, the situation remains very much fluid and changing by the hour, and markets continue to react to rapidly evolving news. So given all of this, I think it's great timing to hear from Anders as well as Jacob how they see the situation and also, of course, how we are acting in our different strategies. So if we begin, Anders, with you, the Strait of Hormuz is, of course, key to the oil prices. So that is one factor. And much of the attention is focused there and also focused on the risk of a broader regional escalation. So how do you assess the situation as it is at the moment?
So unfortunately, I've spent a lot of time on the Hormuz Strait and Iran. You might have seen the Swedish ship Imperative being hit by a missile. My name is on the financing for that ship because I'm on the board of Stena that owns it. A couple of years back, we had one of our tankers taken by the Iranians and the crew was hostage for quite a long time. So I've spent quite a lot of energy of understanding the Hormuz Strait. Stena runs 75 tankers, so it's obviously a fairly important part of our business. The strait is narrow. It's very complex to navigate. You have to go very slowly and really crisscross your way through it. You all know that roughly 20% of all oil passes through the Hormuz Strait, and it would be very complicated if it was closed for a prolonged period. I can't really foresee that will happen. I think given the strategic reserves that we have and the commercial reserves that we have, the global oil market can withstand something like, let's say, 20 to 30 days. We are in a situation where the seaborne oil reserves are bigger than they've been in many, many years. We actually have roughly 10 days of consumption afloat a day. And you should also note that China actually brought a number of ultra-large crude carriers out of the strait just the weeks before this happened. So I do think that we are in a situation where the oil market can withstand this. And partly this is obviously due to the fact that we have an oversupply of oil right now. Obviously, we can't have 6-7 weeks of a closure in the Hormuz Strait. After roughly 20 to 30 days, oil production has to be shut down. And as you probably know, it's very complicated to restart an oil well. And as I've told you about Stena, they also own a number of oil rigs. So I know that business fairly well. I don't think that this will be a major macroeconomic shock. For the last 35 years, if you look at the data, S&P 500 oil prices and 10-year bonds, after 6 to 12 months, they've either been normalized or actually in positive territory. I believe that if you see oil prices of this level between 80 and 90 for the second quarter, and then normalization will happen, this will be a minor impact on GDP in US, Europe, and also Asia. So I don't think that geopolitics is a big market driver. And the reason for this is that it really hasn't been for the last 35 years. And there's also a put here. Let's remember that Trump is running this war. He has General Brent, General S&P, and General 10-year bonds that are reporting to him every morning. And if it becomes a problem, I think the US and Israel will make the Hormuz Strait a very, very strategic military goal. And then I actually think that they can, let's say that it takes a week or two, but they can absolutely wipe out the Iranian forces close to the strait.
Thank you, Anders. And particularly interesting to hear some hard sort of facts and figures in today's age of social media and often clickbait news. And I mean, I very much agree with you that sort of whether or not the Hormuz Strait can be closed for an extended period of time or not will be the key question to keep an eye on. But comforting to hear that you think that it's more likely that it will open up sooner rather than later. We're obviously in the field of asset management. We have a lot of large investors on the call today. Apart from, Strait of Hormuz, you mentioned also Trump being sort of sensitive to the S&P and the oil price, of course. What are the sort of key factors that investors need to keep an eye on in this scenario?
Well, I actually think that the starting point was a fairly healthy economy, particularly if you take an Asian perspective. Almost all, if you take India, China, Asian countries, all of them are growing between 4 and 7%. Current account balances are in very good shape. Most of these countries run surpluses. If you look at public finances, none of them are very indebted. And China has a big debt, but they also have a very good balance between real rates and real growth. Inflation, let's remember that the tariffs for Asia was a deflationary shock. China flooded the markets with cheap goods. And almost in all of these countries, inflation is well contained. You probably saw that India went below 2% a couple of months ago. So I think the fundamental underlying forces, urbanization, better educated population, high productivity growth, etc., will, you will shave off a 1/10 of a percentage point or even 2/10 of a percentage point on growth in Asia. But the fundamental starting point here is that Asia is on a very strong trajectory. In the US, you've probably read a lot about the AI capex, but let's remember that China is seeing something very similar, and they are actually leading on commercialization and production in this area. If humanoids will be a factor, it's pretty clear that the humanoids will be produced in China. So I think Asia is in a pretty good shape. If you compare it to the US or Europe, there are much more worries about structural issues such as indebtedness and unemployment and lack of productivity, particularly in Europe. So I do think that the fundamental case for Asia remains very strong.
That's good to hear. As we know, emerging markets, of course, make up north of 80%, Asia makes up more than 80% of the emerging markets index. So, of course, emerging markets as a whole are heavily dependent on the development in Asia.
And let me add that China is actually a constructive factor here. They are one of the biggest importers of oil out of the Hormuz Strait. Iran has a link to China, that's pretty clear. And what we've seen out of Beijing so far is actually that China is arguing that they need to allow the Hormuz Strait to be open. This is, if oil prices go to 100, champagne will be bottled up in Texas, while China will have the biggest negative implications. So the geopolitics of oil is very different from the 70s or the 80s. So I actually think that China is trying to pressure Iran. And if you have both China and US pressuring you, you might actually listen.
Yeah, no, that's a good point. And just before we let in Jacob, if we sort of conclude, Anders, again, sort of looking at the situation as it is on the ground today in the Middle East, if we make sort of a scenario analysis, I guess the million-dollar question is how dragged out or how long this sort of war can continue, whether US and Israel are sort of managing to weaken Iran enough in the next few weeks' time. So what's your verdict? Difficult question, of course. But
it is difficult, and it's a huge implications for the oil market. If Iran turns into a Libya, there will be less oil supply. If Trump manages something close to Venezuela, let's remember that Iran has huge oil reserves. The system is underinvested. They've only been producing 2 to 3 million barrels a day and exporting roughly 1 million plus. If you would allow Western, let's say Exxon or BP to get back into Iran, with those reserves, they would easily ramp up to 4 or 5 million barrels a day. And let's remember that would make them number 4 or 5 in global oil production. So there is a potential that Trump says that he has 8, 9, 10 or 11 goals for this war. And when he's satisfied with a situation in Iran where they don't finance terror or go for nuclear arms, it's pretty clear that he would allow Iran to become a country that is investable again. He would probably even demand that Iran becomes a country that is investable again. So that is a pretty strong put in the oil market.
Thanks, Anders. Fascinating as always to listen to your thoughts and insights. And of course, we will continue to closely monitor the situation moving forward. So Jacob, welcome.
Thank you.
Dialing in live from China. So we heard a bit of the macro backdrop for Asia from Anders. And if we then move to the market perspective, as I mentioned in the beginning, particularly South Korea has seen a lot of volatility this past week. But bear in mind that this is off the back of very, very strong performance last year as well as year to date. So if we look at the implications for emerging market equities here over the medium term, what are your views on that, Jacob?
Yeah, so maybe if I start with just showing how Korea has done, and just to give you some numbers and background, and then we can go back into the more general emerging markets discussion. So here you can see, as you mentioned, Marcus, last year was very, very strong for Korea and some of the other Asian markets as well, for that matter, right? I think there's been a lot of talk about, bubble and hype, etc. So I'll give you also some of the valuation numbers. But the Korean market, as you can see, it was up close to 50% year to date. So I don't think it's strange to see very kind of sharp correction, right? Because a lot of people want to lock in gains and maybe desperately want to lock in gains. And the 1 week return here is minus 12%. Having said that, the Korean market has since bounced and it is up about 30% year to date in dollar terms. Taiwan up about 16%. And then you have Hong Kong and India, which have been the so-called funding market. So investors have been selling Hong Kong and India and then maybe some Chinese shares to buy shares in Taiwan and Korea, right? So they are pretty much flat or slightly down year to date. So from my point of view, this conflict is pretty far away from Asia, and Asia is 2/3 of, or the main markets in Asia, let's say, and those are 2/3 of the index in emerging markets, and we are give or take country neutral in terms of how we run the fund, right? So I don't think it's any major, disaster. I don't think anything has changed in the emerging markets case. I mean, just to recap, right? Why would investors look at emerging markets? Well, because I think the first reason is probably that what used to work in the past 10 years is not really working. The US hyperscaler or Mag 7 or whatever you want to call them, those trades are not really playing out the way you want to, right? Secondly, there's weakness in the dollar, so there's another reason to sort of get out of the US, right? So I think you're seeing this diversification out of the US, probably a bit accelerated. Still early stage, but I think we are seeing some of those flows going to Europe, going to Asia. And as Anders mentioned, emerging markets today compared to what they were 15 years ago, it's night and day in terms of the macro, right? Now you're speaking about the Chinese renminbi appreciating against the US dollar, not depreciating. You're speaking about, in general, a stronger macro picture in emerging markets compared to developed markets. And then finally, why did you own tech companies in the US? Well, probably because you wanted growth, right? Where else can you find growth? Well, not much in Europe, maybe a few select companies, but you probably need to go to emerging or for that sake, frontier markets. So that's the other reason I think why the emerging market case as such is intact. I will speak later a bit about our fund, but the earnings growth for the benchmark for the index is 34% this year and 15% for next. We are above that in our fund. So you still are seeing very sort of healthy growth number for emerging markets.
Thanks, Jacob. A lot of good information to digest there. And I can also see that the South Korean market is actually flat today, which is quite encouraging to see as well, given the past days' volatility. But of course, as you point out, still up 30% year to date after this week. So important to zoom out as well in this volatility that we're seeing. I also just wanted to sort of remind you, the listeners, today, as Jacob mentioned, we strive to be more or less country neutral in terms of how we allocate to countries in our global emerging markets fund, which hopefully should help us in situations like this when we see significant volatility. Again, Jacob, just going back to the fundamentals, listening to you, it seems like these moves we're seeing are more or less all to do with flows and kind of nervousness rather than anything having changed in the emerging markets case.
Yeah, so I think in the emerging market case overall, nothing has really changed, right? So my job is very much to to do the stock picking each and every market, right? What kind of good stories can we find? Emerging markets are still up 7% year to date versus MSCI World, which is overall markets, especially the US market, up 1% year to date, right? I think on the global side, I'm not too worried. I was reading data this morning that if you look over the past 4 decades, there have been 21 strikes by the US in the region, in the Middle East. And the S&P in 95% of the cases was over the level compared to before the strike 4 weeks afterwards. So 95% of cases, basically the S&P recovered, right? So I think for global markets, they're going to recover. And I think that emerging markets were just like slightly higher beta than global markets, right? So I think for the global picture, we are fine. Korea is far away from the Middle East. And I wanted to go back a little bit to the sort of the chip and memory trade in Korea. The large question I think a lot of people are asking themselves is, what does this AI cycle mean? Who's going to make the money in the cycle? And I think we are very much convinced that it's the makers of the picks and shovels that will make the money. It's the chip makers, and especially Hynix. I think there can be and should be question marks raised for all the hyperscalers and the $660 billion in capex they're doing this year, mostly AI related. What kind of return will they get on those? But I think if you make the picks and the shovels, you typically make pretty good money. I won't go through all the details here on this chart, but we can just say to you that the demand is growing and the capacity is limited. So the price per unit, right, is growing. So the price, especially for the HBM, the high bandwidth memory chip, the AI memory chips are growing. If you look on the bottom left, you can see that basically there's going to be no capacity added in 2026 and 2027. I met with Hynix in Seoul in December, and they confirmed that only mid-2028 is going to be any capacity. Typically, the cycle turns 6 months before the capacity kicks in. That would mean end 2027. I'm not thinking that's the case now. I think it's going to probably end a bit earlier. We made very good profits on Hynix. We sold net 4.5% of Hynix in the past 2 months. So this year we have been trimming the positions. We still have a bit of an overweight, but it's much smaller now. So I think we sort of want to take the profit and also outperform. So technically we were selling a little bit. But I'm not worried that this memory sort of cycle is over. I still think it has some legs to go. But again, we are not a hedge fund, so we want to be positioned a bit more carefully these days, I think, in a company like Hynix. And just to give you some numbers, so here you can see the stock price of Hynix versus the earnings revisions. But you can see here that the expected earnings growth for Hynix 2026 is about 200%. That was 50% 6 months ago. So it was revised from 50% growth to 200% growth, right? And the customers here are NVIDIA, Alphabet, Microsoft, etc., right? these are customers with very deep pockets that are not particularly price sensitive. So this is driving this sort of super cycle. And looking at the valuation, this is a P5 stock. It's cyclical, so of course in 2028 more capacity will kick in, right? But this is why we have been decreasing the position. But I still think there's no bubble here, right? That's just my point. There's no bubble. I don't think Hynix would be a P3 stock. Yeah. So I think that's in short on Korea.
Thank you, Jacob, and incredible earnings revisions indeed there for SK Hynix. And obviously you touched on the positioning there in Korea. At the risk of sounding repetitive, we aim to be more or less country neutral in our fund, and instead, focus all of our efforts pretty much on the stock picking aspects, which is where we think we can deliver the most value. So finally, Jacob, are there any other themes, in or outside of Korea that you want to just briefly touch upon in terms of how we're positioned in the fund today?
Yeah, so I think the largest things we have been doing year to date is we've been, as I mentioned, we've been shifting things around a bit in Korea, and we've been a net seller of Korea again because it outperformed, right? And our holdings in Korea outperformed the index in Korea. We have been selling a little bit in DRAM producers in Taiwan. There's a company called Nanya Tech, which is producing the DRAM, so not the HBMs, but DRAM is the memory chip in your mobile phone, and the prices of those went up very significantly. So we've been trimming that. Again, it's more portfolio management. We did that a week ago, pretty good timing. In the Middle East, we have been slightly reducing the positions in the UAE. I think what's happening in the UAE is it was hard to unfortunately estimate that you would have this type of results, and of course it's horrible what's happening. But for example, we sold out of a stock called Emirates NBD. It's the largest bank in Dubai, and we still have a 7% gain year to date on that stock, right? So that's why we decided to sell it. We sold it yesterday. So yes, it was down a little bit, on the back of the turbulence, but still, I think with a 7% gain year to date, I think that was fine. And today we are deploying a bit of cash into the markets because markets are in general quite soft today. So we thought it's good to deploy back some cash into the markets. But what I wanted to show, maybe to round it off here, right, is just, what are the numbers? Because I think it's very important to just look at the numbers and not, panic or do some sort of abrupt measures in times like this. So if we look on the earnings growth for the index, I mentioned it's 34%, right, for this year. Next year is 15%. If you look for our fund, we have 49% earnings growth this year, so significantly above the index. And we have 18% for next year, so slightly above the index. And then we have a P ratio of 11 versus 12 for the index. So I think this is the typical situation. We are slightly below on a P basis and slightly above in terms of growth, maybe now a little bit more above. So to me, this is a PEG ratio of 0.5, right? If you look on 2026, it would be a bit higher. Maybe if you look on the 2026 and 2027 combined. But I think that's still very attractive. And I don't think anything really changed in terms of investors slowly reducing their exposure to the US market. Yes, some of the Middle Eastern markets are in our index, but it's a relatively small part of the index. Again, the big sort of Asian markets, they are very far away from this turbulence.
Thank you, Jacob, for that comprehensive run through. And as you mentioned, if you look at sort of the direct GCC region as part of the emerging markets index and our fund for that matter, that equates to approximately 5%. So relatively benign, as you point out. So with that, I see we're running out of time. So thanks again, Jacob, and thank you to all of our listeners for joining today's webinar on short notice. And we hope we've managed to provide some helpful insights as to how we see the current situation on the ground in the Middle East from Anders, and also, of course, how Jacob and the team are managing our emerging markets portfolio in this type of environment. Situation, as I mentioned, remains fluid. We'll continue to monitor developments closely and take action where we see it appropriate to do so. So with that, don't hesitate to reach out if you would like to schedule a separate call with either Anders or Jacob, and we'd be happy to set that up. Thanks a lot. Have a good day.